Yeah, let's do it.
Okay, awesome. We are excited to have everybody here. We know it's the holidays, and holidays can be a busy time for business owners because not only do we have the family parties and shopping and all of that stuff going on, we have company Christmas parties, year ends, and so we really appreciate everybody taking the time to come in and get more knowledge. We want everybody to leave these webinars in a better position for business than when they got on this webinar. And so again, we appreciate everybody. We're super excited about these, and we are just going to keep on making them better. We're getting ready to meet up as our leadership team and really line out next year. And next year, we're going to make a calendar with every month what to expect. It will have the date of the webinar for that month. And so you can plan the whole year in advance. And we'll still send out the reminders the week of and whatnot, but we'll know kind of what the topics are and get it knocked out so you guys put them on your calendars. We realized at the end of our webinar last time, our favorite part is the Q&A. We love getting to know you guys better and answering specific questions. And sometimes we get a little bit tied up in that and forget about some of the topics. And so the one topic that we forgot about last month was PTE. And this is a great topic, especially for year end. And so I'm going to let Brian start out there.
All right, yeah. So PTE means pass-through entity. And let's take a little bit of a step back. We'll do a little bit of background on this so you understand what we're talking about. So before the 2017 tax law change, you could deduct for federal purposes on your itemized deductions. You could put an unlimited amount for whatever you paid for state and local taxes. That includes sales tax, income tax, property tax, whatever kind of taxes they charged. And so you could deduct those taxes on your Schedule A as part of your itemized deductions. In the 2017 law, they passed a law that capped that deduction at $10,000. Okay. So that affected a lot of people. Now, the way the media talked about it, it affected California, New York, where there are high income taxes, or a combination of high income taxes and high property taxes. But actually, a lot of small business owners were negatively impacted by that law change. And so states kind of took a step back and said, all right, this is going to hurt our small business owners. How can we help them? How can we find a way to allow them to pay income taxes for their businesses and still allow them to get the full benefit of the deduction? So the way they did that is California came up with a rule, and they said, look, you can donate money to the state. It's a charitable contribution. We're a 501c3. Donate money to the state. If you donate money to the state, we'll allow a credit against your individual income tax. So if your company, S corp, partnership, etc., a pass-through entity donates money to the state of California as a charitable contribution, we'll allow you, the owners of that pass-through entity, to take a deduction or to take a credit against your individual income tax liability for the amount that your company paid. Because this $10,000 restriction on state and local tax deductions does not apply to entities. It only applies to individuals. And so California said, well, this is easy. We'll do it this way. We'll do a charitable contribution and we'll let them get a credit. Well, the IRS came out and said, no, you can't do a charitable contribution to a state and take a credit on your income tax. That's just, that's just shady. We know exactly what's happening. And the law does not allow for a charitable deduction if you're getting something in return. And if you're getting a credit for the amount of your charitable deduction on your individual income tax return, you're getting something of fair market value, so you do not get to take a charitable contribution for that. Other states watched that argument kind of play out and said, what if we establish a law that allows entities to choose to pay income tax? So an entity can choose to pay income tax on behalf of its owners, and it chooses to pay that income tax. It pays the income tax, and then the owners get a credit against their individual tax liability for their portion of whatever the entity paid. Okay. And this is actually very similar to some rules that states have for non-resident owners of partnerships or S corporations, where they make the partnership or S corporation either withhold on behalf of a non-resident partner or actually pay file a consolidated tax return and pay the tax on behalf of the non-resident partner. Okay. And so this fit very well into kind of pre-existing rules related to pass-through entities. The IRS took a look at the structure of a few of the ways that these states set it up and said, yep, that works. So that deduction is deductible at the pass-through entity level, and you can take a credit against it on your individual income tax return. And so in essence, what it allows people to do who are owners of pass-through entities like S corporations and partnerships to pay the tax at the entity level. Okay, so if I'm a sole owner of an S corporation, I'm the sole shareholder of an S corporation, and I have a $25,000 state tax liability that's going to come due on my flow-through income, right? My pass-through income from that S corporation. I can have the S corporation pay the $25,000 of tax to the state, then report that to me on the K1, and I actually get a credit for that $25,000 against my state income tax on my 1040, right? Or my state version of that individual income tax return. And so rather than being limited to a $10,000 total deduction, I actually get the entire amount of the $25,000 deduction that I otherwise would have missed out on. And so this pass-through entity tax is different for each state. All the rules are just a little bit different. Some require you to pay the tax before the end of the year. Some allow you to pay it up through March 15th. Some require you to make estimated payments, or say that estimated payments are required, so you have to do it throughout the year, just like you would for an individual if you had to make estimated payments for that state. So a lot of the payment requirement timelines kind of track along with the individual estimated payment timelines that states already have established for high wealth individuals, especially. Some are a little bit more restrictive. Like in Utah, you have to make the payment by the end of the year, right? The amount has to be remitted by December 31st in order to qualify. And so it's something to be aware of for your state. Now, this isn't going to apply to everybody, right? But if you have a high state income tax liability and it's going to exceed that $10,000, and you have either a partnership or an S corporation with positive tax income this year, it's something that you should consider.
Can we break that down into a quick 2 or 3 sentence? What if exactly what you're looking at as the business owner and what to do? And
yeah, so again, you have to be the owner of an S corp or a partnership in almost every state. You have to have positive taxable income from that entity that you're going to report for the 2023 year. And you have to either not plan on itemizing for any other reason, or have a state income tax liability related to the income from that business that will exceed $10,000, or that will push what you otherwise would have deducted for state income and property and sales taxes to more than $10,000.
got it.
And if I can just add in super quick too, I have a little map pulled up so people kind of know, if you're in a certain state, if this is something you need to worry about or not. So 36 states have this currently. There's 3 states with proposed bills. So they don't have it yet, but they most likely will soon.
Trevor, do you want to share your screen with us?
Absolutely, yeah. So this is the...
Take a look at that map.
Let me get that done here. Oh, I'm not able to share my screen actually. I can let you know which states it are. So the 3 states that have it proposed, they don't have it yet, but it's going to come in the future, so keep an eye on it, are going to be Vermont, Pennsylvania, and Maine. And then the 9 states with no income tax at the owner level, there's no income tax. There's nothing to deduct, right? And then there's 3 states currently that don't have it and don't have proposed bills for it. North Dakota, DC, and Delaware. So if you're in those states, don't worry about it. The three I mentioned before, it's going to come in the future. If you don't already pay income tax in your state, it's nothing you need to worry about. And then everywhere else, though, it's something that you may want to look into if you already meet those qualifiers that Brian had mentioned.
Perfect. Thank you, Trevor. Now, on to the next thing. I know, there's some things that we can do as far as tax deductions and tax incentives after December 31st. And there's other things that we kind of have to have done before December 31st. And so what I would like to touch on is some of those deductions or strategies that we may want to utilize, that if it's not done right now, we should probably get it done in the next week or so.
Yeah, that's excellent. Yeah, and I put a link in the chat. I tried to share my screen, it wouldn't let me either. I put a link in the chat that shows the map that Trevor was talking about. So if you want to just take a look at that, it'll walk you through a couple of the rules, has a couple of other pages on it as well that can help you. So let's talk about things that we really need to take care of before the end of the year, okay? Now, this is kind of a broad list of topics, right? And so there are some things that are going to apply to you, some things that are not going to apply to you, and that's okay. Not everything has to apply to everybody, right? One of the things that we often see or use as a strategy is paying our children for the work that they do for our businesses, right? So if we have a child who's doing work for us, we can actually pay them if we have either a sole proprietorship or a partnership where only the mom and dad are the partners of the partnership. We can actually pay the child without having to pay the Social Security taxes, right? The employment taxes, which is nice. You get a deduction at the entity level. You pay your child for the work that they do for your business, and that can range from helping out at a food truck to cleaning the office for you to helping you stuff envelopes for stuff you're going to send to your clients for Christmas or for the holiday cards and stuff like that, right? So there's lots of things that they can do for you to kind of earn money. And so if you are going to pay your children, you got to do a W-2 for them. So make sure you get those things paid by the end of the year. Get that deduction for your business for this year. If not, just wait till next year. And so you can pay up to that standard deduction amount without them having to pay any income taxes for federal purposes, and without having to pay the employment taxes, as long as you pay them, as long as your company is a sole proprietorship or is a partnership with just mom and dad as the partners. Okay, so that's one of the things. Now, last time we talked about, and it's only been a couple of weeks, and I know that it's only been a couple of weeks since that webinar, but maybe not everybody's had a chance to watch that if they weren't there or couldn't participate live. So a couple of things to think about. Bunching of itemized deductions. We got to make sure that we do that by the end of the year. And bunching of itemized deductions, just really briefly to kind of remind you what that looks like. If you're close to the standard deduction amount and you itemize each year because you have charitable contributions or large property tax payments or large medical bills, stuff like that, and those are consistent pretty much year to year, you're really close to the line where you could either itemize or take a standard deduction. Go ahead and prepay for your charitable contributions, for example, and push yourself past the itemized deduction limit for this year. Next year, take the standard deduction. And so you can do this every other year. So rather than having like 26,000 of standard deduction things and or 26,000 of itemized deductions, 27,000 of standard deductions each year, you could do 52 of itemized deductions in year one and 27 of standard deduction in year two, and you can actually get a bigger deduction over time. Okay, and so we call that bunching. We try to kind of put everything all at the same time in the same year so that we can take that deduction and max out our itemized deductions for that year. Another thing to think about: placing assets in service. If you know for sure that you're going to go buy a machine or piece of equipment for your business over the next couple of months, crank it out, get that done before the end of the year, place it in service, make sure that you're using it for your business, and you can take that depreciation this year rather than next year, right? So we're just kind of talking about accelerating the timing of deductions just a little bit. Those are probably two of the biggest ones that people think about. One thing that people often don't really consider is different retirement plans have different timelines and deadlines. Okay. So we all kind of know that an IRA contribution, you've got till April 15th to do that. That's not a big deal. But for some of the 401k plans or plans that we have inside of our entities, those deductions, those payments for those plans need to happen before the end of the year. Okay. So there are some 12/31 deadlines for stuff like that. Talk to your plan administrator, look at the documents for your plan specifically. There are so many that we're not going to go through all of them in a list right now. But just pay attention to kind of when the deadline is for that.
Thank you, Brian. Trevor, do you have anything you'd like to add?
I did want to touch a little bit. Brian had mentioned placing your assets into service. I feel like every year I have a client that's super excited to take the deduction on the bonus depreciation on the new Model X Tesla Plaid that they ordered that they're not going to see for 8 months, right? So paying for a vehicle or paying for an asset does not necessarily mean that you can deduct that asset that year. It has to be placed into service, like Brian said. So for vehicles, it's got to have at least 1 business mile on it by the end of the year. So by December 31st, you got to hop in it, put a business mile on it. Now we can deduct it. If we're looking at rental properties, right? That's something that people will go out, maybe they're planning on doing a rental anyways, and they know they're going to have a big tax year. So they go out and buy a rental at the end of the year. It has to be placed into service, meaning it's available to rent. So if you bought a rental property, but you're closing on it, you've maybe just closed on December 31st, no way you could get that thing rented out that day. It wasn't placed into service. It'll go on next year's tax return. So just be mindful of that, placing that into service by the end of the year. And that's pretty much it. Also, a few other deductions, like we've got the Augusta rule, things like that, maybe people we've talked about before, which would be renting out your home to your business or really renting your home out to anybody, right? Tax-free if it's under 14 days. That would need to happen by the end of the year as well as paying, you need to be paid for that service. So just a few things like that. We obviously talk a lot about putting tax strategies into place, and then, we get to filing tax returns. They're like, well, I want to do all those tax strategies we talked about. It's like, well, did you move the money, right? So just make sure we're placing into services and getting that money moved by the end of the year.
Yeah, and we have a couple of related questions here in the Q&A. My affiliate marketing business did not gain any traction this year and hence failed to generate any income. Am I still allowed to deduct actual expenses incurred in the year? So not generating income isn't necessarily the cutoff for that. What we're actually looking at is an active trader business. And an active trader business is one where you have the ability to receive income. You're actively attempting to receive income. You just haven't gotten paid yet, right? So if I'm a door-to-door salesman, I'm out knocking doors, trying to sell something, and a customer just hasn't received the product and given me the money yet or something like that, I do have an active trader business open at that point. So we need to pay really close attention to the date that our business became open or active, or we became open for business. We actually were actively pursuing the profits in that business. And that's the date that we can start taking deductions. We have another question. If I took out a loan on a vehicle to start my new business, can I write off those payments? Sort of, yeah. So if you took out a loan on a vehicle and you're using that vehicle 100% for business, for example, then you can actually deduct the interest related to those payments, and you can deduct depreciation. So you don't get to deduct the principal portion of those payments, just the interest portion. The principal portion covers the purchase price, and that purchase price is going to be recovered through the depreciation deduction over time. Okay.
So one question I get asked a lot, Brian, is purchasing a vehicle for the business versus lease, because it does make a difference on taxes.
It does make a difference. And oh boy, this is a tough one. Okay. And let me just tell you, and we got a question, if you pay cash for a vehicle, just go ahead and you'll just take the depreciation deduction. You don't have an interest component to worry about, right? So you'll just recover the cost through depreciation. So purchasing a vehicle, you recover the cost through depreciation. That could mean that you have bonus depreciation if it's a pickup truck that you use for business for 100% for business, for example. It's over that 6,000 pound limit. There are higher deduction limitations. With SUVs, you go down to a good number, but lower number. With what they call luxury automobiles, which is basically a vehicle under 6,000 pounds gross vehicle weight. You're more limited in your deduction for depreciation each year. And the reason for that is, and it used to be, by the way, just a few years ago, it was still the case that if you got anything past a brand new Geo Metro, the luxury automobile limitations just killed you on it. Okay. But those limitations have kind of changed a little bit, which is nice. But there is still a big limitation. You're looking at about 20 grand between bonus depreciation or 179 and the deduction for the first year for a luxury automobile. And a luxury automobile is just a car that costs over a certain price. It's not necessarily a luxury automobile as you would consider that if you saw it driving down the street. Okay. So purchasing, we recover through depreciation, and it can be limited. So in the market for like a Mercedes X-Class or something like that, you might see in the market for like a brand new Mercedes or a brand new Audi or brand new BMW, that most dealerships are saying, hey, come lease this vehicle from us. And the reason they're telling you to lease it is because lease payments are often not limited. Okay. So with lease payments, I can just deduct the lease payment, and that lease payment would represent a large payment each month. And so I can actually get a bigger deduction than I would if I bought the car and paid payments for that car. And those payments that I pay for that car might be a little bit less than a lease payment. But with the tax deduction, it actually makes more sense cash out of pocket. I actually reduce my out-of-pocket cash cost for the vehicle by being able to deduct the bigger lease payment. If you're an S corporation or a C corporation, there are some chargebacks for leases that the owners need to be aware of. In terms of taxes, we actually add a little small amount to your taxable income, but it's often insignificant compared to the savings that you get. So leases can be very good, and it depends on several things. One, it depends on the cost of the vehicle. Two, it depends on the kind of vehicle, right? Is it a vehicle like a truck that has a gross vehicle weight of more than 6,000 pounds? Is it an SUV? Is it a sedan? All those things matter. The entity structure that you're using matter, and how much you use it for business is also going to matter. Okay, now one place that we can get caught, because, look, TikTok videos, Facebook videos, all those things, they're very popular because they take a very strong stance, pretend like everybody else is an idiot and only certain people know this rule, and then give you one very limited, very specific example of a rule and how it applies. So if we listen to those videos, depending on which video we listen to, lease might be the only thing in the world that anybody with any kind of intelligence would do. But the fact is, it's very much more nuanced than that. And you can get whiplashed on the tax consequences of a vehicle that you lease and start deducting and then don't use all the way for business. There can be huge consequences for that. So we need to be careful about it. Take a breath, get some specific tax consulting, and make sure that you're doing it right. Okay, let's see here. We've got a couple more questions. And while we're answering these questions, I'm going to create a little whiteboard here. See if it'll let me create a whiteboard. I'm going to put the link in there. Okay, let's see here. All right, can you guys see that whiteboard?
Sure can.
So I think you should be able to click on that and copy and paste it. Or you should be able to type that in. If you type that in, that should get you there. Okay, let me know if that kind of fixes the problem there. We've got a question. If my startup costs for my business are this year, but the business doesn't open until after the new year, do I lose the ability to take my startup costs as deductions? You do not. You don't lose the ability to take those deductions. You just take them after you start. We'll be able to take up to $5,000 right away. for most people, and then we just deduct the others over time, kind of like depreciation for a new asset. We've got a question about taking out a loan and paying for monthly payments, go through the affiliate marketing education platform, have not had any income. They do have an EIN, formal business license. So again, so the interest on payments for that loan is either a startup cost, which is something you can deduct after you become active in your business, or if you already are active in your business, then it's an immediate deduction. So
We're getting comments that the screen is blank. On my side, I can see the letters, but for some reason on their side, it looks like they're not able to see it.
Oh, they can see it now. Good.
We got it. We can see it. Well,
All
we
right,
got another
good.
one that we can't.
It just came up. All right.
I think we're good.
Okay, thanks, guys. Yeah, so as far as that goes, again, what we're looking for is an active business. And an active trader business is a business where you have the ability to collect income, you have the ability to provide those services or goods to your client, and you are actively pursuing the ability to do so. So you're actively engaging with clients, you're actively promoting, marketing yourself, you're trying to make money, and you have the ability to make money should somebody say yes. Okay, that's usually the sign that you're an active trader business. Now, the IRS isn't in love with the active trader business rules. Their default rule is that you've made a profit in 3 of the last 5 years. Yeah, sure. If you've made a profit in 3 of the last 5 years, they're not going to try to argue that it's a hobby. And most of the rules related to this active trader business relate to a hobby versus an actual business. But, you know, for most of us, it's not a hobby. We've got a business going. We're spending money. We're trying to make it work. We're trying, you know, we're putting in the effort. We're putting in the time, and it'll start coming in. We don't necessarily have to wait until we start actually getting income to make it work. All right, I'm going to leave that whiteboard up for just a second, give you a chance to type those out. Click on that link. Hopefully it's big enough you can see. You don't need to, yeah, so let's see. Let me just make sure that I've got the whole link in there. Okay. I think I didn't get quite the whole link. So this is the full link right there. I don't know if you can copy and paste that or if you have to type it out, take a picture, a screenshot of it, and work on that. You can also Google, if you Google, let's see, PTE space tax space map. Click on the first link that popped up in my Google was from the AICPA and CIMA is what it's called. And it just says states with enacted or proposed pass-through entity. That's the one I clicked on, okay? So if you Google PTE as in pass-through entity space tax space map, I guess you don't have to put the spaces in there, right? Just put the space, hit the space bar. Okay, all right, let me see here. Check my questions and answers real quick. They have to take a screenshot. Thanks, Jeff. All right. Taking out a personal loan to start your business is okay. It's not whether the business name took out the loan, although that would be ideal. That's not always how it works. A personal loan that you take out where the interest is used for your trader business is also okay. We have to be a little bit careful about the rules related to, like, if you take out a home equity loan or something like that, you need to let us know what you use that home equity loan for. So if you take out a home equity loan or a mortgage on your home and you send those documents in to us, it looks like that was used to purchase or improve your home. And so you need to tell us, hey, this is for my business and this is how much I spent on my business and this is how much I paid in interest. This is the principal of the loan, et cetera, right? So just give us that information. We don't recommend you go out and take out a loan for your business and get a car loan all on the same loan. Just because it's harder for us to bifurcate year to year. It's hard to keep track of, right? You have to make sure you keep track of it. Even on a personal line of credit, again, as long as we know that it's for your business and you tell us, hey, look, as long as you're not reporting it to us in a way that makes it look like it's something else, like a mortgage payment, as long as you're reporting it to us and say, hey, this is the interest I paid for my business, that's great. We'll put that in there as a deduction for your business.
Right. And just to add on to that, as far as documentation for things like that go, if you've taken out a personal loan or using personal credit cards or personal cash, we don't personally need to see the documentation, but it's very, very important that you hold on to that documentation and put it somewhere safe for at least a few years.
Yeah, absolutely. Absolutely. The recommendation is at least 7 years for those records. Keep the business records for at least 7 years. We don't need to see every receipt. I don't want to see every receipt for every tool you bought, for every meal that you had, for every travel. I don't want to see your travel log. You just need to keep a travel log. And that's especially important when we have a vehicle that we use for business. We have to keep a log of that. We have to keep track of it so that so that we are able to take the deduction. That's one of the questions that it asks us as we fill out the tax return. So you got to tell us, did you keep a travel log? What were your total miles for business? What were your total miles for personal? We have to know all that information, right? And then, we don't have to keep all the documentation for you. You can keep the documentation. There are some things that we ask for documentation for. If we have a question, we might ask you about it. Just because, we have to do our best to report an accurate income tax return, right? That's really important. It's important for us to be able to continue to work with you and continue to be able to file tax returns with the IRS. So we're going to do our best to get the best, cleanest, most complete information we can. But you don't have to give us every receipt. Just make a list of the itemized deductions that you have. Make a list of, your deductions for your business, right? Just make an itemized list of those things, or just say, hey, look, here's how much I spent for utilities. I don't need to know per month. I just need to know the total amount for the year for utilities. And that'll help facilitate a quick turnaround time on your tax return. As we're talking about that, the fact is tax season is a little crazy, right? We have a March 15th deadline for some types of entities, an April 15th deadline for other entities and for individuals. And we're going to extend your tax return as a matter of just professional practice. Okay. It's a great idea to extend your tax return for a couple of reasons. One, we can still file the return timely. And so if we file the return timely because we got all of your information on time and we got it all taken care of and you got it signed, we got it sent in, then it doesn't change the deadline for when your return was due. It does not extend the timeline for audits or for review by the IRS or anything like that, right? It's not a trigger to extend your tax return. It's a normal course of business thing. If you, but the fact of the matter is, we're people, right? We're people who have to sleep, we have to eat, we have to, go home and pretend that our family still knows who we are. All of those things are important. And we're going to work really long hours during busy season. Okay, we call it busy season. We're going to work really long hours and we're going to be extra available. We're going to be available late into the evening. We're going to work weekends. We're going to put in a lot of time. To kind of put it in perspective, if you take the number of overtime hours we are going to work during busy season, that's a full 8 weeks of work time. Okay. So we're going to work a ton of extra time. We're going to do our very best to make sure that everybody we can everybody who gets us their information in a timely manner is filed before the original due date. We'll do our best. Okay. But that being said, incomplete information, not giving us what we need to be able to complete it, not filling out the organizer that you receive, all of those things are going to slow down our ability to do your tax return. And we have a lot of clients who are going to be and I'm preaching to the choir here, right? You're here on the webinar, you're paying attention, so you're going to be the kind of clients that I'm about to talk about. We have a lot of clients who do a very good job of filling out the organizer completely, asking the questions quickly rather than sending us incomplete information and waiting for us to ask them a question. They fill out the information completely and ask questions as they go, so that by the time they send in the organizer and the attachments with the documents, the other documents they're going to send to us, everything's full and complete and clean. We can get those returns done quickly. And so those are the returns that are going to be at the front of the line, right? And we do have timelines. We need to make sure that we go to sleep because it turns out that if you stop sleeping and don't eat, you're not going to do a very good job on people's tax returns, right? So we're going to do our best to completely take care of everybody who gets their information timely. We have, as with all things, we've done a lot of work during the last couple of months to make sure that we are, as organized as we can be. Done a lot more training with our administrative staff to make sure that, look, we need to make sure that these documents are taken care of and that all the information is cleanly filled out in the organizer before it goes to a preparer. We're going to save a lot of time that way so that our preparers and our reviewers are focused on the returns where people have given us complete information. It's easiest for you to, while you're filling out the organizer, if you run into a question, call us, ask the question. And that doesn't mean, and we're actually going to provide videos that kind of walk through the organizer as a whole and walk through different sections of the organizer for you. We'll have all those available for you early in the year. Watch for your tax information to come in. Put it in a safe place. Put it in the same place. Things are going to start flowing in right at the end of the year. January is a big month for reporting information. Things are really going to flow in there, all through January, early February. Take those documents, put them all in the same place. Read through the organizer before those things start coming in, and you can put those things in the organizer as they get there, get it all done, however works best for you, kind of process-wise, right? Get that information to us in a clean way. If you have a question, watch the video. If you still have a question, call us. Let's answer that question quickly. And we will give you an organizer via email. Thank you, Wendy, for asking that question. We are going to give you an organizer via email. You'll get a link and it will show it to you. You'll also have links to where you can upload the documents and get all of that information in as well. But if you can do that cleanly and completely, give me just a second, I'll answer that question in the chat. But if we can do that cleanly and quickly, then we can do a lot better job of getting your return done quickly, getting your refund to you, which I know is important, especially as you start and operate a business. It's nice to have that refund quickly. We're going to do our best to get it to you as fast as we can. Okay.
And let me touch on that just a second, Brian, unless you're not done.
Well, what I was going to say is we have to temper our ability to do things quickly with also the cost that it costs us to do those things so that we can keep our prices reasonable for our clients as well. We could certainly get every client done before the deadline simply by hiring a whole bunch of other people, right? But then the cost would be prohibitive. Then we're talking about big firm costs where you're going in and you're getting an individual return done, and you're paying $10,000, right? And we don't want to pay $10,000 for only a 1040 plus another 20 grand to organize your entity and another 30,000 to do your business return. Like, that's not who we want to be. So we're trying to keep our costs down as much as possible. And for most of our clients, they don't need that kind of service. Now, we do have clients where that is the kind of level of service and the level of business that they have that we have to do those things, right? And for those, we're happy to do those things, and it does cost a little bit more, right? But for a lot of our clients, we can get you taken care of without having to get up into the $60,000, $70,000 fee range, right? And the way we do that is to be efficient.
And that is a real thing, just so everybody knows. There are firms out there where the minimum to even get through the door to do a return with them is $250,000 for one return. And we definitely, we don't want to go there.
That's right. No, and there are clients who need that level of service, right? Like, I have clients, we have clients that are, I have clients I personally work with that we're doing stuff for, where the level of service they need, the complexity that they have, the level of service they need for the year, it's going to cost them $50,000 to $80,000 a year. And that's okay. That's fine. Right. But not everybody has to be that. And that's what I was trying to illustrate, right? If you can be patient with us, we'll get to it as fast as we can. We are going to work a ton of overtime and try our best to get things done in a timely manner. But your information getting to us in a clean and timely manner with things completely filled out really does help.
Yeah, I think that was kind of a hurdle that we've had over the years. And so this year, we're super excited to just be better about not only setting proper expectations, but giving our clients the proper information that they need to be efficient. And so as far as the organizers are concerned, The organizers have to update every year as the tax code changes. We just barely got updated organizers last week, and we are currently putting together training videos. So we'll get those organizers out within the next couple of weeks. And we're also going to be sending out with those organizers access to training videos, as well as having webinars in January and February if needed, but we'll do multiple webinars in January. We're going to try to get one done on a Saturday as well for those of you that maybe can't make a Monday through Friday appointment, where we'll be able to go through and answer questions, do live Q&A, kind of go through some of the topics or questions on those organizers that we got people calling in. Hey, what's this? If we hear it a few times, we'll just throw it in that webinar and get those questions answered.
Yeah. And in addition to that, you're also going to receive what we call an engagement letter. Now, the engagement letter is kind of a lengthy document, and it's kind of lengthy for a reason. We have to give this engagement letter, and it has to provide enough information for you to kind of understand all of the rules and obligations related to tax rules that are constantly changing. So this is a little bit different than our contract, which is the contract you initially sign when you sign up and engage us to provide services. The engagement letter is something we do need you to sign along with that information you're going to give us. But the engagement letter, what it does is it kind of walks through the current laws related to requirements. For example, it'll have a discussion of foreign income or foreign bank account, foreign account investment reporting rules, right? It'll say, hey, just as a reminder, if you have foreign investments or a foreign bank account or something like that, you do have to report it if it gets to a certain level, and it will describe and discuss those things. It will give you a reminder of, a discussion of what an extension is, and the obligations and liabilities related to making sure that you pay your tax payments on time, and all that information. And so all those things are going to be contained in that engagement letter, which is it's a really important read, especially the first time you see the engagement letter from us, to make sure that you read it thoroughly and understand the terms and conditions under which we're going to provide the tax return services. This is something that's required by our insurance liability carrier. Our liability insurance carrier requires us to provide an engagement letter to you that kind of lays out the terms and conditions and everything like that, to make sure that we're all on the same page, that we're operating in a way that's clear and clean with you, just like you do with your customers, to make sure that everybody's on the same page and we don't have any hard feelings when something, when there's a misunderstanding, right? So we're going to try to be as clear as we can, and doing it in writing with an acknowledgement from your signature, with your signature, is the best way for us to accomplish that. Okay, I've got a couple of questions here. Where do we enter debt in our chart of accounts and QuickBooks under business expenses? Debt will just go under the liability section of QuickBooks. So make sure that it shows up as a liability. And QuickBooks has the ability, with whether your debt is a note payable or like an account payable or even a credit card, as long as you make sure it goes in the liability section, it will make sure that you can actually track. It will sync your credit cards, and it will track the debt payments and the interest amounts and the credit card payments and stuff like that as well. So that can be helpful. Let's see. We've got a question. We incurred a 5-figure loss due to a hacked crypto NFT account that's part of my business.
That's a tough one.
Yeah. So I'm reading a couple of times just because I want to make sure that I understand everything that's being given to us here and the information. All right. So losses related to crypto NFT accounts are hard to kind of give a broad answer to. I'll have to look at it specifically, but basically, so here's a couple of answers. Number one, our crypto accounts or NFT accounts are just general investment accounts, will gain money, right? So that income, like the value will grow. So let's say I put in, $10,000 and it grows to $100,000, okay? Or $10,000 and it grows to 50 grand. So, I've got this $50,000 account, somebody comes in and hacks it, and I lose that money. Now, there's a couple of ways that can be treated depending on who did the hacking and who is liable for it. Okay, if it's a hacker, it's a theft loss. Theft losses are not itemized deductions anymore, and so we wouldn't be able to take that deduction. If it's like, and if at the entity level of the company that where the amounts were stored, if they had an internal issue that lost your account, that could be treated as a business loss or an investment loss, which is treated a little bit differently. But that 2017 law basically said no more deductions for theft losses, that are personal in nature. If it's business related, the rules are different for a theft that's a business related theft. Those losses are deductible often. If I put 10,000 in and it was at 50,000 when it got hacked and stolen, or when it got stolen out of the business, just like any other asset, like a tractor can get stolen from a business or something like that, I'm going to be able to take a deduction for the cost of that. So the 10,000, not the 50,000 of fair market value. So if you put in, 5,000, it grows to 50 and it gets stolen, in your mind, and I agree with you on this, it's a $50,000 loss, right? It was $50,000 of value that is no longer there. But for tax purposes, the deduction would only be 5,000, and that deduction only happens if it's truly a business loss. So we have to make sure that there's documentation of how that got into the business and that it is in fact a business loss and not just an individual loss. So we can work on that more specifically. If it's an individual loss, then yeah, until the law changes back to where it was before, which doesn't happen until 25 or 26 even, then it would not be deductible. If it's truly a business loss, that means it has to be inside the business, and we just have to be able to prove that it was truly a business loss. Hope that answers the question. Excellent, thank you. Okay. Okay, so I think we've answered all the Q&A that are available here. Does anybody else have any questions that they want to ask us? Anything else you want to talk about? I hope you all have a Merry Christmas and that you have all of the happy things going on in your life with your family and everything that you're hoping for this year.
Okay, let's wrap it up. Again, we appreciate everybody for putting your trust in us and our team. And we're committed to continuing to get better and to continue to educate our clients. We really appreciate you guys. I can't say it enough. I hope everybody has the best holidays, the best Christmas, and we'll do the same, but we'll still be here in the office. So if you need us, reach out to myself, reach out to your business advisor. We'll have a team here. Thank you.
Yeah, happy holidays, everyone. Thank you for participating. Have a great day.